Hello guys, my name is Kevin. I'm from CBB Bank. I've been doing SBA loan for all I can remember. So here I go. This is 5 C's of credit under SBA loans. The 5 C's of credit. The 5 C's of credit are used to assess the credit worthiness of a potential borrower and to determine their risk. The character, capacity, capital, collateral, condition. So we'll just kind of get into that. We'll probably talk about capacity the most because related to cash flow. So measuring character, this basically, when it comes to character, banks are basically looking for anything that may hinder the loan payment. So the first thing will be the credit score. Does it meet the minimum SBA requirement of 650? Are there many delinquent accounts with delayed payments? Does the borrower have any bankruptcy on their record? Does the borrower have any criminal records? Not looking for any misdemeanor, but violent crimes or any fraudulent related. Even seeing high gambling income or losses is not a great sign.
So you can actually check if somebody has been gambled before?
Well, on the tax return, you can see like gambling income.
Oh, that's right, because there's a place for it. That's why when you win on the slots, they give you a 1099 or whatever.
Exactly,
That's
exactly.
right.
exactly.
There's a full
I never
background
thought
check
about
on
that.
Yeah.
Is there a full background check on these loans?
Full background check? Yeah.
We'll check their criminal records, everything.
So
Maybe make a conversation about it.
yeah. So like for example, we just had a borrower, everything kind of checked out. One thing we saw was 18 million in gambling income, but there was no taxes. I'm like, what happened with that? I go check. There's also 18 million in gambling losses. I'm like, okay. And my credit team's like, they didn't want to do this because I mean, this guy won 18 million, but he ended up he went and lost it all. I mean, he broke even, but like to the bank, it's like, how that's your level of like, deciding like, can't you walk away from
18 million.
18 million. I was like, oh
You can't walk away.
yeah. So that's that.
Wow.
Next one. Understanding capacity. I think this is probably the most important C of the 5 C's. So capacity, or others will call it cash flow. Lender will typically look at the last 3 years of the business cash flow. Does it fluctuate? Is the income trend going up or down? Or is it steady? So at the end of the day, what the lenders are looking for is sufficient DCR. DCR is a debt coverage ratio, and the minimum DCR required for an SBA loan is 1.15. But what the heck does that even mean? So the DCR of 1.15 means that the business's net operating income should be at least 1.15 times the annual SBA loan payment. So simply put, if your annual loan payment is $100, your NOI should be at minimum $115. So here are some of the expenses that lenders typically add back, making the cash flow better, which are depreciation, amortization, rent, officers' compensation, interest, and such.
Can I add to that? Most people always do what we call in lending the debt service coverage ratio, which is right there, right? But you need to have a spreadsheet, which I believe you as a banker, you guys have your own debt service to coverage ratio spreadsheet that you run through. Most businesses don't have that debt service coverage ratio because unless you have somebody who actually know how to do it, you're just spinning wheels because all you have is your taxes, your profit and loss, your balance sheet, etc. You're never gonna have that. It's very internal, in my opinion, that specific.
Yeah, it's good to keep in mind for business owners if they're trying to get a loan in the near future. They should really see how they're going to file their taxes, because I'll say 99% of the business owners, they're gonna want to try to save money on taxes, right? So it's just gonna look like they're at negative, but technically they're not. But for us to do the loan, it needs to look like you guys are making some money.
Question. So on your DSCR calculation, because it's an interest was I think put back. What sort of interest is that? Because
Any kind of interest that you see.
So what about a cash advance interest? The interest rate, the interest that you pay on a cash advance, were you guys able to add that back?
Yeah, we're able to add back all the interest expense we see on the tax return. But obviously that doesn't include like the principal payment, just interest.
Yeah. So if your business you have a line of credit, factoring, facilities, interest, and also for those one could all be added in. And you said about the Was it the director's commission?
The add back of the wage.
Yeah, oh, the
So-
wage?
Yeah, so the expense items that you could add back to make the cash flow better. I mean, and banks always add things back, which were depreciation, amortization, officers' compensation,
Officers,
officers, because that's what you're getting paid.
Right,
And
yeah.
that's not really an expense. You just add that back.
Mm.
Interest I talked about. And rent, you can only add back rent. Let's say the case is a business is trying to buy a real estate to operate their business in. And since they're going to operate there, they're not going to be paying rent anymore. So we add that back because we're going to service the debt anyways. Yeah. So, I mean, what we discussed thus far is related to the cash flow of the actual business itself, but the other sources of income, such as income from other businesses, rental income, wage income from spouse, all play a big role in determining the capacity of the borrower. So it's not just the subject business income. So if there's additional income, we'll consider that into the overall global cash flow, which helps the borrowers.
You can actually add that to.
Well, not to the business cash flow, but overall global. So let's say the business cash flow is just right at the tip.
Yeah.
But looking at the global cash flow is good, then the bank is gonna move forward with that, most likely.
How would you look at when people have two different businesses? They have one business, which is the one that is getting the loan, but they also have another business that is actually bringing income, but most important, profits. Would you take that in consideration? And if you do, why would you take that in consideration? And would you add that as collateral to issue a loan? And I say that because I do have a client like that.
Yeah.
So I'm trying to get some clarification.
Yeah, I mean, the subject business is the business that's actually getting the loan has to meet that minimum DCR of
Yes.
1.15. But if it's right at the cut of 1.15, most lender are going to see, I'm like, yeah, it meets it, but like, what else are there?
Okay.
So at that point, we're gonna see that other, business generating income, and banks gonna feel a little more secure knowing that they have additional income. Let's say this business kind of craps out, then they have another business that could be paying the loan, right? So
Okay, if it's a new business, what happens then?
if it's a new business, then obviously we have to base it on a projected cash flow. But for us to do that, we can't just get any new business and do production cash flow. So that's when the borrower's experience comes in hand. So we need to see if the borrower has experience in owning and operating a business in that industry. So once we cover that, then we look at the business plan and the projection cash flow done by the borrower to assess our own cash flow.
How about as far as industries go? That's focus on.
We do any kind of industry as long as it's not illegal, non-profit, or like pyramid scheming. So like no church, no weed, because this is a federal loan.
Yeah.
But
What if it's a for-profit illegal business?
Uncle Sam wouldn't like that, Okay.
You get it, capital?
The power of capital. So this is basically the down payment. Lenders like to see you have skin in the game. The more you inject into the business or project, it shows the commitment from the borrower. So depending on the transaction of down payment, it could range from 0 to 30%. So for example, like a partner buyout, let's say you're buying out a 50% partner, the bank already see that you own 50%. So they will see that as your investment or your equity in the business. So to buy out a partner at 50%, they don't have to put a down payment. So in that kind of scenario, it would be 0 down payment. 30% is when they're trying to buy only business, no real estate involved, no collateral, then it'll be at 30%.
How about as far as if it's real estate?
If it's real estate, it's 10 to 15%.
This is for an SBA?
Yeah, or SBA loan, 10 to 15. I'm specific talking about SBA 7A, but covering SBA 7A also covers 504 as well. So
The 10 to 15% might include a CDFI joining with you, right? One of those CDC loans.
Yeah, so 504 is an SBA loan where there's two lenders. The first TD lender will be us, basically. A second lender is a nonprofit CDC organization, basically from the government. They're doing the second half of the loan. But yeah, for us to get into that, we need a little more time. So yeah, we'll skip to the other one. I think.
The benefit of collateral.
Oh yeah, so benefit of collateral is, pretty much.
Let me ask you another question. Let's
Yeah,
say
go ahead.
the total project is 10 million.
Mhm.
And you, does that, but the real estate is, let's say, 6 million. So when you're applying for an SBA loan, you have to do the, let's say, 10 to 30% on the total project or just on the real estate?
Well, what is the project? Is the project including the real estate?
Correct, yeah. The total cost of the project is 10 million, but the real estate portion of that is 6 million.
Right. So for example, they're buying a property and they want to,
Correct. Start a
fix
business.
fix the property and get it up started.
Pay all that down.
Right. So in that case, it'll break down. The down payments will be 10 to 15 on the real estate, and whatever the project is, the project cost it should be around 30%. But also that also depends on if they're willing to pledge additional collateral, since the loan is not fully secured. So let's say the loan is fully secured, then we could go low as 10% for both. And it's very case by case. I know it sounds kind of confusing, just throwing numbers around like that,
In a
but
scenario like that, experience actually matters, right?
absolutely,
Absolutely. Developing property.
exactly. It's like, yeah, that's also a startup, and we have to base it on projection cash flow. Which means, yeah, this guy, if that loan got approved, he definitely has other businesses that's operating, that's generating good income.
Okay.
Yeah.
Strong.
Yeah, especially 10 million. Yeah.
Yeah.
I mean, that's a max
You
on a.
definitely have experience when you get approval of $2 million.
So SBA 7A maxed out at 5 million. 504 could go up above 10, depending on the scenarios. But did I talk about collateral? No.
Oh, no.
No, no.
Sorry.
So benefit of collateral. I mean, collateral basically makes a loan a lot of times. So unless you're using the loan to purchase a property, you typically need to pledge a real estate collateral. If you have multiple properties, you just need to pledge a property with enough equity to cover the loan amount. If you don't have collateral, it doesn't mean you cannot get a loan. I've funded plenty of loans without real estate collateral, basing the loan on borrower's experience and the strength of the business.
I'd like to add to that collateral will be based on the industry that you're in, right? Because I was telling them before you came, Kevin, well, we were talking about just the new SBA program that is out there that is technically for manufacturing companies, wholesalers, and professional services. And in this specific program, they're not taking any real estate. It's literally only based on payout. So just think about that. Collateral is always going to be based on industry, because if you're a truck driver, and your collateral is technically a truck, right? The reefer, stuff like that. And I believe there's other, like self-leaseback, there's other financial instruments that will play in that type of scenario. So always take that as depending on the industry that you're in.
So we are at condition now. This is basically market condition, location, target market, seasonality. These are the typical conditions that may affect the business operation. Is the borrower trying to buy a business catching the last wave of the trend before it dies out? Will the new location of the business affect their average income? Any external factor that may affect the business, the underwriters will take into consideration when determining the credibility.
Does anybody have questions on that one, conditions? I feel like out of the 5 C's, that's the most confusing one.
Yeah,
Conditions.
it doesn't really affect many scenarios. I mean, at this point, we're looking at is the business economy proof, and what business is economy proof? Is it for medical or
You guys do your own market studies?
Oh yeah, the underwriters have to. Yeah, but yeah.
Honest scenarios.
Yeah, this is some loan scenario. So like recently funded loans and their key points of getting the loan approved. So remember, even if the borrower is missing some of the 5 C's of credit, the other C can be strong enough to mitigate the risk. So we have a restaurant. The restaurant owner purchasing the property where they currently operate. The business cash flow wasn't that great, but it was sufficient. And seeing how the business operated for more than 30 years, and since it was not relocating, we were confident that the business should be able to maintain their current level of income. But let's say they were trying to relocate like 20 miles, 30 miles, then this case would have been a little bit harder to get the loan approved because everybody knows that restaurant is there, moves 20, 30 miles away, are their royalty gonna be, there to keep coming to that restaurant? So, that kind of stuff affects it. I have a gas station purchased a gas station that was mismanaged, which meant weak cash flow. We were able to mitigate the weak cash flow due to the strength of the borrower and the business location. The borrower had sufficient ownership experience, currently owning 2 other stations with positive revenue. The loan was fully secured by the subject property and additional real estate collateral. So at the end of the day, business location was great and at a high traffic intersection near the freeway. So given the borrower's experience, we believe that he was able to bring the sales back up to a level of normal operation. So that was basically another projected cash flow deal.
You technically approve a loan based on the strength, the experience of the borrower, and also much of the financials of the business.
It's financials first, and then, if we have to go into projection, then we will look into, how was the cash flow low because it was mismanaged, and then now we're projecting to be better since it will be under better management, or, that's like the only case that projection will work, unless it's a new business.
What do you guys determine that meant?
Cash flow speaks as well. We look at like comps nearby, and we do a lot of car wash gas stations. We kind of know, like, oh, this should be doing X amount. So yeah.
Historical data.
I guess in their heads.
Oh.
Because they've done so many, we've done so many. So.
When you actually say about the experience in the field, was it like that specific field or it was the related field? Let's say, for example, you have a gas station, right? The gas station, you have three parts of the business on them. One of them is your actual gas. The other one, let's say you have the car wash part of it, and you have the
C-store.
The C-store,
Yeah.
right? Let's say you have experience actually operate the C-store. Does it mean in that perspective you guys will consider that better? Or because you've done only C-store before, but hey, you've never done a gas station?
Yeah, gas station, that part do translate over a little bit because it doesn't take a genius to run a gas station. As long as C-store, we could see that he did that well, then, we're gonna believe that he has the ability to learn to run a gas station. So it does translate a bit.
It does translate, okay. Yeah.
But for that person to buy a mismanaged will not get approved. For that person trying to buy a mismanaged gas station with weak cash flow, bank is probably not gonna approve that. Yeah.
There's an opportunity for it.
Exactly. So somebody who has actual, because we could see that through tax return of his other business. I'm like, okay, he's doing well. He knows what he's doing. So if he just buys this, he could at least run it to a normal level of operation. So we just kind of believe that, he should be able to pay the loan, basically.
Gas station is one of those businesses that, now that you say that, it's funny how you said it. It's like, doesn't take too much brain to run a gas station. In Orange County, whenever you have time, there is a guy or a family that owns a bunch of Chevrons, and it's called GNM. I don't know if you noticed, at least they all over Anaheim, Santa Ana, Stanton, they have at least, I saw the financials, over 100 gas stations over there. Everybody who works in those gas stations does have, and I'm not, diminish anybody, right? But the guy told me, it's like, I just see people with high school and the willingness to work. And I felt it well. Everybody else pays 17, 18, 19. I'm paying 22, 23, 24, 25. I don't care. But they're loyal, they stay. Boy, am I making money. Oh, it's like over $50 million. Not no revenue, but now that you mentioned that, it's funny, right? Because it's one of those pieces that you don't think they, at least I thought it was just Chevron and the big corporations, but no, it's technically like a franchise.
It is a franchise.
It is a franchise.
It's either a franchise or it's a company. Or the reason I actually know on the gas station, I could ask that is because I got customers who actually deal with a bunch of the gas station chains in the Midwest. I actually myself also had a meeting with them when we actually supplying them coffees, working on projects, and all those kind of things. That's why I was asking that details about it, because they actually owns like. They actually initially owns like 80 gas stations, but they were actually owned part by a huge company. But I think a third of it owned by like a family, which is like the old money there. But then, like you said, they have a chain of like 30 gas stations that they acquired.
Wow.
And so on. And then they acquired another like 20 gas stations, a different one is there. Like you said, yes, there is a part of this, like the 10, 20, whatever gas station that they got acquired and then got bigger and good and so on.
And it sells. It's like, man, like 5,000 on a low day to $10,000 on a high day daily.
I mean,
And it's 24/7. They don't close.
they're pretty like location sensitive. You know,
Yeah.
they're at a good location. They have to do well. High traffic, near the freeway. They're bound to do well.
But these 5 Cs, generally, which is the most important, which is the least?
Yeah, cash flow is probably the most important. The capacity. The least important was probably condition, because it doesn't really apply to every businesses out there. You know,
And for new business, if there's no cash flow, how do you determine that?
we determined that by, I guess, borrower strength. If we look at capital from his other businesses, if he has other sources of income, if we look at his character, and then collateral.
I'm always curious about the borrower's capacity, right? For example, you know, there will be a time, I'm sure that, you know, many of us have actually gone through the economic, like this economic problems that obviously will impact your issue and how you can run the business. Then how does it translate into you when you're actually making decisions based on the borrowers? Because, you know, there will be a time where no matter how good you run your business, you got hurt as well, right?
Right. So what the underwriters do usually is at the end of the credit memo, they try to cash flow it with higher interest rate to make sure if they're gonna be sufficient with that amount of loan payment. I mean, that's how they do it, to see how they would sway depending on the economic.
Oh yeah, usually I know some of them they do like 1.5 times 1.5 times the ratios to see how well that
Yeah,
you
similar.
can actually like, you know, be flexible to be able to cover that.
Right. Exactly.
But yeah, I mean, like, you know, you will go through, I mean, not you will go through, I'm sure maybe some people don't, but some people will have gone through a big cash. I mean, 30 years doing business, there's no way that, you know,
Yeah,
you
I mean,
know,
most businesses are like affected by the economy, so it's not like we're gonna put that on every single borrower each single time. You know, we do know that happens, but we look for stuff like, is a business like location sensitive? You know, we're not gonna, if there's like a target market of this one business, like this area, but they want to open up this same business here, but the target market isn't there. If it's not there, it's not going to do well. So, I mean, those are like the conditions that banks look for, but in terms of the economy, like, kind of applies to most businesses.
That's good. I just learned something new.
Yeah.
Yeah. I didn't know about I was always assumed that, but I wasn't 100% sure that you guys would do that test.
somebody
That
told me,
1.15, but I actually went to the 1.2.
somebody told me it was 1.5.
Right?
So
Yeah.
there's no point in opening a Italian restaurant in China. So it's
Yeah, basically, yeah.
Yeah.